Hello, very good morning to all, and welcome back to today's Daily Dose. Very interesting movement on the global markets right now as we are speaking. The US stock market retreated yesterday, led by the underperformance of the Dow Jones Industrial Average, where we anticipated as expected, where we have a short-term bearish buyers move on the US Wall Street 30 CFD that is representing the Dow Jones Industrial Average on the backdrop of rising longer-term US Treasury yield. And with this backdrop of a rising US Treasury yield, coupled with rising geopolitical risk premium that saw oil prices rally close to 3 to 4% yesterday as the 2 months plus of US-Iran ceasefire agreement or truce has started to get expired. And US President Trump yesterday mentioned that he does not have the intention to extend this ceasefire deal. In today's Asia session, due to this concoction of rising longer-term US Treasury yields together with a push-up in oil prices that triggered a short-term risk-off behavior in the Asia Pacific stock market, together with a uptick in the US dollar that saw gold prices yo-yoing below a minor range resistance that we highlighted yesterday. Very good morning to all. Today will be the Tuesday, the 18th of August. So before we kickstart, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a recap in the last 24 hours, what has taken shape in the global markets. Then I will follow up with selected intraday technical setup for instruments that I personally have an opinion that could move at a higher volatile rate. And we'll wrap it up in terms of key events / economic data to look out for today. So let's kickstart what has taken shape yesterday. So just to make sure that my screen is good, yeah. Yes, it should be fine. So let me share my screen over here. So let's start with the news flow first. So the first one I want to share with you guys will be the pertaining to the Middle East, particular center on oil prices. So yesterday, the US, Iran interim kind of a peace deal kind of officially expired after 60 days. So the key thing over here is that yesterday, in a kind of a not press conference, in a kind of a media interview, US President Trump mentioned that he's not interested for now in extending the expiry agreement with Iran. And over here, tensions get renewed over the Strait of Hormuz that has sparked flare-ups in hostility, and there have been no movement on addressing Iran's nuclear capabilities. So apparently, this stalemate has started to re-emerge, which means that both sides are now trying to re-engage in the game of poker. And also over the weekend, we had mentions that there's renewed fighting in Lebanon over here. And Lebanon is one of the key allies of Iran, and Israel has mounted a new offensive in Lebanon. This renewed fighting would likely complicate efforts to revive a deadlock negotiation between US and Iran, which means, i.e., the game of poker re-emerge. So that actually causes oil prices to rise within our expectation, which is now West Texas crude oil and as well as the Brent crude oil is now trading above the 20-day, 50-day, and the 200-day moving average, indicating some form of short-term bullish momentum coming back into the oil market. So with this resurgence of what you call it geopolitical risk premium, coupled with this rise of the longer-term US Treasury yield over here. So let me share with you. This is the 30-year US Treasury yield, right? So this is a 30-year US Treasury yield. So the 30-year US Treasury yield has managed to clear above a major sideways range configuration that was previously in place since October 2023. Now holding above at 5.31%, and 5.31% is the highest level that is being seen since January or June 2007. So that is now trading at a 19-year high. So the 30-year Treasury yield is now trading at a 19-year high. That also causes the US dollar to recover slightly as we are speaking right now over here. So if you look at the US dollar index, so the US dollar index managed to stage a bounce right after a test close to the 200-day moving average yesterday at 99.26. So printed a low of 99.29 over here. So it managed to stage a recovery and it closed at negative 0.06%. And in today's Asia session, it's almost unchanged. So yesterday's US dollar weakness was kind of negated during the US session, where the 30-year US Treasury yield spiked up to a 19-year high, breaking above this major range resistance level previously was in place since 30th of October 2023, and it closed at 5.31%, which is a 19-year high. So the reason why we start to see a longer term spike up in the longer term US Treasury yield, which is the 30-year, is due to a very lackluster auction in the longer term US Treasury bonds. So this lackluster auction or issuance of US Treasury bonds market is due to two things. Market are now concerned about surging US government spending. So that created a dollar debasement narrative coming back into the picture. So that also allows gold prices to remain firm instead of triggering a sell-off in gold, despite the fact that we know that gold and longer-term US Treasury yield are kind of competing asset classes. So rise in longer-term US Treasury yield indicate higher opportunity cost of holding gold. But this time around, gold did not trigger a significant sell-off because of this potential debasement narrative that's coming back into picture. That means investors and traders are now showing a lack of distrust on the US government or whether they service the debt in the longer term given this surging government spending over here. And also one of the movement is being we call it triggered by competing similar asset classes in the longer term fixed income market. So we know that in the last 2 months or so, there has been a ramp up of corporate borrowing. That means corporates are using a long-term debt instrument, especially those mega cap technology hyperscalers that are ramping up financing with the likes of Alphabet, Meta Platform, Nvidia to fund artificial intelligence investment booms. So that's more related to AI infrastructure plays that potentially suck out demand for traditional buyers of longer dated US Treasury bonds. So this is more of related to similar asset classes within the asset space competing for the thirst of fixed income demand. So we know that recently, in the last 2 months, there has been a ramp up in corporate debts, long-term corporate debts. That means i.e. 10 to 30 year of fixed income instrument from corporates. These issuance are being used to fund AI infrastructure plays. And given that such high issuance by longer term corporate debts, in order to entice investors or traders to come back into the longer term US Treasury market, that could the lack of demand. So given this demand supply equilibrium, the 30-year US Treasury yield or the 10-year US Treasury yield got to go up to actually attract buyers into this segment of the fixed income market. So yes, that actually explained the movement of the spike up in the 30-year. So with this 30-year spike up and together with the push up in oil prices due to rising geopolitical risk premium, that causes the US market to retreat yesterday. So the worst hit was the Dow Jones Industrial Average, down by negative 0.51%. Which I explained yesterday due to a rather weak technical configuration as it starts to retrace or push down within a minor bearish flag formation. So later I'll share it in a second when I cover the update on the US Wall Street 30. So the Nasdaq 100 also retreated yesterday, but up pretty firmly, not managed to perform far better, only down by negative 0.17%, thanks to a positive gain on the certain segment of the US semiconductor industry, where the semiconductor index managed to close positive at 1.64%. So if you look at the heat map of the S&P 500, we start to see certain stocks close in the green. Micron is up by 4.13%, 3% yesterday. Intel up by 0.97%. Texas Instrument up by 1.19%. And we have some other semiconductor equipment related stocks like Applied Materials up by almost 6%. So that managed to offset certain weakness that's been seen in the software segment of the technology sector, where Microsoft is the worst performer, down by negative 3% yesterday. So overall, we start to see a bit of, we call it retreat on the Nasdaq 100, but that retreat is not so severe as compared to the Dow Jones Industrial Average and even the SPX 500. All right, so that's a wrap for the first segment of the Daily Dose. So let me now move on to the second segment where I share with you guys interesting intraday technical setup that I personally have an opinion that it could have a higher volatility movement on the intraday basis for today. So before we do that, let me expand my screen over here. All right, so let's start with the FX market. So one thing I want to cover will be the euro dollar. Right, euro dollar. So euro dollar, if you could recall yesterday, we do have a bullish bias. Bullish bias hit our resistance zone, which is 116 figure, 116.20, right exactly at the 20-day moving average before it did a pullback during this US session. All right, so objectively has been hit yesterday. Bullish bias has been hit. Resistance level has really fulfilled the movement. And right now, we start to see a bearish divergence on the hourly RS. Oops, pardon me. We start to see a bearish divergence on the hourly RSI. Right. Then thereafter, it starts to exit from the overbought level, indicating that right now we potentially may see a start of a minor setback for the euro dollar for today. So hence, for today intraday session, I will flip to a bearish bias for this minor setback to get underway using 116 figure, 116.20 as my short-term pivotal resistance level. Minor corrective intraday setback support level to watch, 115.44, maximum 115.17, 115 figure level, that confluence right exactly at the 20-day moving average, a rising 20-day moving average. And if you do the Fibo retracement of the prior minor bullish impulsive up move sequence from the low of 28th of July all the way up to yesterday's London session high, that would be the 38.2% Fibo retracement. So hence, this is only a minor corrective pullback. It potentially may not change the short to medium term uptrend phase of the euro dollar. So i.e. once price level come very close to the 115.17, 115 figure level, I'll be on the lookout for any form of a short-term positive element that may occur on the euro dollar to flip my bias on the bulls again. But right now, price action is still trading way above all this set support level. Hence, I will have a bearish bias right now as we are speaking, 11:16 a.m. Singapore time. Only a sudden pushback up above 116.20 will invalidate today's bearish bias minor corrective setback view to see the continuation of this bullish impulsive up move sequence towards 116.50, 116.85 in the next step, which is the minor swing high of 29th of May. All right, so that's for the euro dollar. Next FX pair I want to share with you guys will be the Aussie dollar. So the Aussie dollar may also now shape a minor corrective pullback after hitting our resistance level yesterday at 71.20, 71.30, which is right exactly at the upper limit of this minor ascending channel from the high of 3rd of August minor swing low over here. And also, if you were to do a parallel ascending trend line support level that has been broken down yesterday, all right, on the hourly RSI, indicating the lack of upside momentum. And given the potential, we call it a negative feedback loop on the global stock market today due to rising geopolitical risk premium, and the Aussie dollar has a very direct correlation with an increase in risk off sentiment, at least on the minor time scale. I will be flipping to a intraday bearish bias as well on the Aussie dollar for today for a potential minor setback using 71.20, 71.30 as my short-term pivotal resistance level. Minor setback support level to watch, 70.85, maximum 70.65, which is right exactly at the lower limit of this minor ascending channel. Hence, given that price action is still holding above the 20 and the 50-day moving average, So today, minor setback will be more like a minor corrective pullback within a short to medium term uptrend phase. So once price action reach 70.65, I'll be on the lookout for new positive bullish elements for the Aussie dollar to flick my bias back towards the boost again, given the fact that price action still has some more way to go towards 70.85 and 70.65 as we are speaking right now at 11:18 a.m. Singapore time. However, if price actions instead of moving downwards to undergo that minor corrective pullback or setback, it starts to spike up above 71.30, then the minor corrective bearish view for the setback scenario has been invalidated to see the continuation of the bullish impulsive upmove sequence towards 71.47, which is the 1.382 Fibo extension, and the minor congestion area of 4th of June breaking above 71.47 may potentially take us up higher towards the minor swing high area of 18th of May and 3rd of June this year, which is also a 1.618 Fibo extension cluster level at 71.85, 72 figure level. So that's for the Aussie dollar flipping to a bearish bias move due to the current intraday technical, we call it elements that has been inherited in individually and based on the intermarket correlation with a potential rise in risk off sentiment in global stock market due to rising geopolitical risk premium and the push up in longer term US Treasury yield. Right, now let's have a look at the global stock market indices. All right, starting with the Japan 225 that is representing the Nikkei 225. So the Japan 225 plummeted as expected. So if you recall yesterday, we do have a bearish bias for this minor corrective pullback to take hold. So minor corrective pullback indeed did that bearish reaction of that 69.425, 69.635 short-term pivotal resistance, and right now is fast approaching our support level at 67.540. So now it's trading at 67.953. So no point maintaining the bearish bias given that it's now coming very close to the 50-day moving average, which is our predefined support level in our yesterday bearish bias move. So instead, I'll be looking for opportunity to flip back to a bullish bias move over here. So basically, there's some levels I want you guys to take a note of as price action now push down to our support level. All right, 67,540, 66,986. So once price action comes down to 67,540, breaching below it, hitting 66,986, because price level hasn't hit this support level yet at 66,986, I do not want to place it as my short-term pivotal support level at 66,986. So instead, I'll be using 66,736, slightly below it, 66,280. So if you will do that Fibo retracement of this entire bullish upmove sequence from the low of 29th of July all the way up to last Friday high, that constitute with the 38.2% Fibo retracement. All right, so using 66,736, 66,280 as my short-term pivotal support zone for today, I will now look for any further weakness that could potentially unfold on the Japan 225 to flip my bias back towards the bulls again, given that this will be the inflection zone for a potential bullish reversal to take shape. 50-day moving average and also the lower limit of this minor ascending channel drawn from the low of 29th of July, and the RSI has already the hourly RSI has already hit the oversold level. So hence looking for further potential weakness to fake this weakness, flip the bias back towards a potential bullish reversal that may take shape today on the Japan 225 once it hit the 67,550, 66,986 level using 66,736, 66,280 as my short-term pivotal support. First resistance level to watch will be yesterday's rejection level at 69,425, 69,635 level. Only breaking above 69,635 will reaffirm the continuation of the bullish impulsive upmove sequence towards 70,427 next, which is a Fibo extension cluster level, 70,427. If price action don't move up as intended and it plunge all the way down below 66,280, then that bullish reversal movement will be invalidated to see price action to stage that deeper minor corrective pullback all the way down to 65,240, 64,895, maximum 64,130, which is the dotted turquoise green line here, which is the pullback support of that former medium-term descending trendline resistance drawn from the current all-time high of 22nd of June. So that's for the Japan 225, flipping to a bullish bias in any form of any potential weakness, given that it's coming very close to the support level at 67,540. All right. Next up will be the update on the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 tumbled as expected below our set resistance level as it continues to undergo this minor corrective pullback within this bearish flag formation. And the bearish flag formation lower limit will be at 52,960 for now. So right now we will have a tightened short-term pivotal resistance level, which is the upper limit of that bearish flag formation, which is also yesterday's London session high at 53,700. So as long as price action don't surpass above 53,700 on the US Wall Street 30, we will have a bearish bias for this continuation of this minor corrective pullback to take shape. Next support level to watch will be 53,415, 53,213, which is the former all-time high area printed on 7th of July, breaking below 54,213, potentially exposes 52,960, which confluence with the rising 20-day moving average. So once price action come close to 52,960, I'll be on the lookout for a bullish reversal candlestick price movement to flip my bias back towards the bulls again. However, if price action don't move down as intended and starts to squeeze back up above 53,700, today's extension of this minor corrective pullback scenario will be invalidated to see a minor recovery to test 53,965, which was last Thursday rejection area. Only breaking above 53,965 will see further up move towards 54,284. Next will be the SPX 500. So the SPX 500 also tumbled down as expected. So yesterday we do have a bullish bias looking for it to go up towards 78.48. So given the current technical configuration right now, and as well as intermarket analysis correlation movement, we do not have a very strong view of a bullish impulsive upmove sequence that may take hold today for the SPX. So with that, for today, we will flip to an intraday bearish bias move on the SPX using yesterday's swing high area at 78.12, which was last Friday minus swing high. Yesterday, during the start of the US session, it printed a high, or during the London session, pardon me, 78.07. So 78.12 short-term pivotal resistance level. Intermediate resistance level will be 77.81. Flip into a intraday bearish bias for this minor corrective pullback to take hold. Two key support level to watch: 77.07 followed by 76.64. Breaking below 76.64 will see the extension of this minor corrective pullback to retest 76.25, which is the former all-time high, and that also confluence with the rising 20-day moving average. So once price action hit close to 76.25, I'll be on the lookout for a bullish reversal candlestick to flip my bias back towards the bulls again. However, if price action don't move down as intended and start to spike back up above 78.12, today's minor corrective pullback scenario bearish bias view will be invalidated to see the continuation of the bullish impulsive upmove sequence unfolding back again into the SPX towards 78.48 followed by 78.94, which is a 0.382 Fibonacci extension level on the upside, taking it from the low of 30th of July. Lastly will be the Nasdaq 100. So the Nasdaq 100 almost hit our short-term pivotal resistance level at 30,380. Yesterday, it printed a high during the London session, 30,250, before breaking downwards, and it also started to print a bearish divergence yesterday. So with that, I will also flip to a bearish bias movement on the Nasdaq 100 for today using 30,250, 30,380 as my short-term pivotal resistance level. Now it has already broken below this Friday US session low level, okay, which is at 29,944. Next two key support level to watch will be 29,720, 29,493, which is corresponding very closely with the 50-day moving average. Breaking below 29,493 may expose further weakness on the intraday basis towards 29,205 that correspond with the rising 20-day moving average as well. So once price action come close to 29,205, I'll be on the lookout for a bullish reversal candlestick to flip my buyers back towards the bulls again. However, if price action don't move down as intended and starts to spike back up, that would invalidate the minor corrective pullback scenario for today. Breaking above 30,380 will resume the bullish tone for it to retest the current all-time high area at 30,728, 30,795 in the first step. So that's a wrap for the major stock indices. So do be on the lookout for those support level that I mentioned earlier on to flip the buyers back towards the bulls against once this intraday minor corrective pullback ended. So for now, maintain a bearish bias view as we are speaking right now for the three major US stock indices as of 11:28 a.m. Singapore time. Onward next will be the update on the commodities market, starting with gold XAU/USD. So gold rally as expected, hit the minor range resistance at 44.34 before before upside momentum got dissipated. All right. So the hourly RSI seems to be trapped by a parallel ascending trendline resistance over here. So with that, I'll be flipping to an intraday bearish bias view for gold XAU to revert back towards the range support again. So 44.34 minor range stop will be my short-term pivotal resistance for today. Flip to an intraday bearish bias for a mean reversion move towards the range stop. Two key support level to watch. First support level to watch out for will be yesterday's Asia session low at 43.69. Over here, let me put it in writing. 43.69. Okay, 43.69. Breaking below 43.69 may expose the key minor range support level at 43.32. 43.20, pardon me, 43.20 that has been in place since 10th of August. However, if price action don't do that mean reversion towards the range support level and instead starts to spike back up above 44.34, that would invalidate today's bearish mean reversion scenario to see the continuation of the push up to test that key upside trigger level of 45.04, which is the 200-day moving average in the first step. All right, so that's for gold. Next up will be the West Texas crude oil. Like I mentioned, the West Texas crude oil rally as expected due to the uptick in geopolitical risk premium. So right now, it already surpassed our first resistance level at 84.62. So this will be a pullback support level to watch for today. So I will have a Titan adjusted pivotal support for today, bringing up to 82.96, which is right exactly at the 20-day moving average. Maintain our intraday bullish bias movement on the West Texas oil. Next resistance level to watch out for will be the minor swing high of 30th of July and 31st of July at 86.58. Breaking above 86.58, 86.58 may potentially take us up higher towards 89.27 and 89.27 if you will do a current parallel ascending trend lines, parallel ascending channel that also confluence with the upper limit of this ascending channel as well at 89.27. And if you do the Fibo extension of this ongoing recovery from the low of 5th of August, that also coincide with closely with the 0.764 Fibo extension. However, if price action don't move up as intended and starts to break below 82.96, that would negate today's bullish tone to see another choppy minor corrective pullback towards 80.84, maximum 79.25 again, which is the 50-day moving average. So that's for oil, maintaining our West Texas oil, maintaining our bullish bias with an adjusted Titan short-term pivotal support at the 20-day moving average, 82.96. So that's a wrap for all the selected intraday technical setup for today. Before we go, let's have a quick look at the economic calendar. What are the key data to look out for today, 18th of August? So 18th of August, as we head into the European session of the London opening, at 2 p.m. Singapore time, we will have UK labor market data to take note of. So unemployment rate will be out at 2 p.m., followed by unemployment change. And thereafter, you have 5 p.m., the Germany and the Eurozone aggregate ZEW economic sentiment index. So that could potentially sway the movement of the euro dollar and the euro crosses. And that's a wrap in terms of the economic data to take note of. And US earnings is still not over yet, Q2 US earnings. So US earnings season, I want you to take note of something very interesting for today. will be the related to the housing market. Home Depot will release their Q2 earnings before the start of the US session. That means before 9:30 p.m. Singapore time today. So very likely it's between 7 to 8 p.m. usually. So Home Depot will release their earnings. So that could potentially influence the Dow Jones Industrial Average, which is our US Wall Street CFD, given the fact that the Home Depot is one of the 30 component stocks of the Dow Jones Industrial Average. So something to take note of between 7 p.m. and 8 p.m. Singapore time today. All right, so that's a wrap for today's daily dose. So do practice proper risk management as higher volatility starts to take hold due to a concoction of events, rising geopolitical risk premium due to the stalemate between US and Iran, and as well as rising longer-term US Treasury bond yields. So with that, I'm Kelvin here signing off, and we shall speak again tomorrow. Thank you.